Everybody's happy to be recorded. Thank you, Henry. Thank you, JQ. I'll monitor the lobby and get that sorted. As usual, if you want to ask a question of, we're calling him JP. JP, is it okay if we call you JP
that's absolutely
or
fine.
John
Yeah,
Paul?
please
JP,
do call me
there we
JP.
go.
Yeah.
So we're calling him JP. If you want to ask JP a question, then just raise a hand. And I think this is JP's first presentation on Playpen, so let's be kind to him, I guess, but be challenging. Ask him lots and lots of pertinent and challenging questions. That'd be great. David, I'm going to mute you if that's possible. There we go. If you've just joined, if you could mute, that's better. There we go. That's fine. Okay, so welcome to Pension Playpen, everybody. Thanks for joining on this wet this morning in London session. We're delighted that John Paul Grenade is going to be presenting from Just. And as usual, if you'd like to ask a question, please raise a hand. Henry Tappert and I will open up the chat room as well if you want to make any comments. And we are now being recorded. So JP, over to you.
Thanks very much, Steve. Thanks for the invite. Good morning, everyone, and welcome to this session. So, as Steve says, I'm John Paul Grenade, JP to pretty much everyone I know. And today I'm just going to talk a little bit about a proposition and thinking more broadly about retirement income and how we might want to build retirement income portfolios in the DC space. So today, I think the key things that I wanted to address were the economic environment and the impact of the economic environment on current retirement income portfolios in particular. Understand the difference between accumulation and decumulating wealth. So I think we find a lot in certainly the advisor space. We've got a lot of accumulation strategies in an ecosystem that supports an accumulation strategy, less so when people are starting to think about decumulating wealth. I think it's important for us to understand some of the different types of risk you have when you're decumulating compared to with when you're accumulating. So we'll touch on that a little bit as well. And then we'll look at historic market movements and understand how those historic market movements are starting to look somewhat similar to what we're seeing right now. So hopefully that all makes sense. So, unsurprisingly, diversification, I think, is going to be a really important feature of today. Before we start to talk about that, I just wanted to highlight this portfolio. I'll come back to it towards the end of the presentation, but I think there are some important numbers here to remember. So this is a firm that we work with very closely, Timeline, that's done some work for us and some modelling for us in terms of decumulation strategies. We're looking at a portfolio of £400,000 split 50-50 in drawdown between bonds and equities. What you can see here is that the modelling says that the portfolio will provide a legacy of £127,000 roughly, and that it's less sustainable. So we're going to talk about some elements of what's happening in the market, and then we'll come back to this later and see if we can enhance that portfolio somewhat. So let's start with risk appetite. So risk appetite's been, I think, really interesting. So when interest rates were really, really low, I think, and I'm sure a lot of you will agree, the customer appetite for risk went up quite a bit, not necessarily because they wanted to take more risk, but simply because they had to, because interest rates were incredibly low. And if you wanted to get a decent return, you had to take more risk. Over the course of the past year or so, a lot of customers have started to reconsider their level of risk. Part of that will be because equity markets didn't perform very well, but also, interestingly, fixed income markets didn't perform particularly well either. And because interest rates have gone up, the amount of money that consumers are able to earn from their bank accounts are significantly higher. So those things in combination mean that customers are probably less willing to take risk than they were previously. I think this is an important feature to bear in mind. So we research that we've seen 70% um, of customers would decrease the level of risk that they're taking, which is pretty um, surprising, to be honest. I think in addition to that, we've had an issue with respect to diversification. So we all know through modern portfolio theory that people generally tend to think of bonds as acting as a uh, contracyclical asset class to equities, i.e., when equities go down, bonds go up, and therefore bonds ultimately protect your portfolio. So what we've done here is we've looked at a few periods in history where you've got a bond equity portfolio. And in every case, since 2000, you can see that although equity markets performed poorly in those years, in an absolute terms, bonds have performed positively at least, which is good. However, they haven't performed well enough, apart from arguably in 2000, to kind of really give a huge amount of protection. You've still suffered a pretty negative experience as a consumer buying a 60/40 portfolio. So, yes, bonds over the past 20 years or so have been protecting your portfolio somewhat, but perhaps not as much as you'd have liked if you've been a bond investor. Now, bonds also don't tend necessarily to perform particularly well when, a year after they've dropped. Um, there are a couple of examples that you'll see on here. So if you look at the second column, where you've got the plus 1 year, you had a 1920, you had a minus 19.7% return, and then a year later in 1920, the return on bonds was 27.4, and in 1994 you had a negative 12.2 year, and then a year later the return was 14.5. So there was an element of bouncing in those two examples. However, in those examples, so in what are we talking about? 1920, 1974, and 1994. In every single case, there were no inflationary concerns. In fact, the view was inflation would drop the following year, and so UK government bonds perform well in those scenarios because the view was that um, the inflationary issues that the UK was suffering from were likely to dissipate the following year. Um, I don't think we're in that environment now, so it's unlikely that we're going to see a significant bounce from gilts. So again, in the advisor world, um, a lot of advisors are using attitude to risk tools, and it's interesting just to look at, when you look at these attitude to risk tools, how do they behave to volatility changes? So this is looking over the past 18 years or so, and you can see there's a reasonably significant period, certainly the last 10 to 12 years, where the overall volatility has remained sort of relatively consistent. And so that has allowed these ATR tools since around 2010 to perform in a way that is predictable and understandable. So you would have expected an ATR one portfolio to have significantly less risk than an ATR5 portfolio, for example, because you've got consistent volatility over a period of time. More recently, though, if we look at the last 3 years or so, that volatility has changed pretty significantly. So it's less obvious that you're going to have a period of time where ATR tools are going to perform in line with the way that they have in the past. And I think this is really important because one of the challenges that customers would have had last year is that they'd have been in low risk portfolios, and then you'd have seen significant volatility in gilts around September time. And so you had a really bizarre period where customers in low risk portfolios actually had as bad a journey as customers in high risk portfolios. And so that's another reason why we've seen what we were talking about earlier, a requirement for customers to reduce the overall level of risk that they're taking. Um, this slide on the right, so the picture on the right that we're looking at now is just showing the kind of volatility for just equities and bonds. And the story is basically very, very similar. The change in volatility um, is is pretty significant. So I guess the question is, how unusual is this? So if you look here at equity versus bond volatility, we've highlighted some sort of specific market events. So you can see the Asian crisis in 1999, the dot-com bubble, great financial crisis, and then and COVID-19. So in every single instance of these, there's some, significant thing has happened that has increased equity versus bond volatility. But recently, this most recent period looks like a, a crisis event. But if you look at this little um, black circle on the right hand side of that chart, it's the second highest circle in that whole list, only slightly below where we were with the great financial crisis. So and so it's a particularly worrying event. And so how is this going to play out going forward? So if we look at equity bond correlation rolling 12 months, again, you can see on here that from 1973 to 1998, you were looking at a positive correlation between equity and bonds. Between 2000 and roughly end of 2022, you're looking at a broadly negative correlation between equity and bonds. But now that circle or oval that you can see on the right hand side implies that we're now moving to a positive correlation between equity and bonds, and it's going to be interesting to see how that pans out over the course of the coming months. Of course, this isn't the first time that we've seen positive correlation between equities and bonds. Um, we've had a very recent period of negative correlation, which you can see on this chart, which is produced by Schroders. But then there's a significant period of positive correlation prior to that. And actually, you'd argue that the positive correlation periods have been larger than the negative correlation periods. So we may well be moving into a new paradigm where there is a positive correlation between equities and bonds, and it'd be interesting to see what happens next there. So this is a chart showing where we have positive correlation. So everything that you can see in blue is highlighting a positive correlation event. So if you look at global total return against the natural resources in line, the first row and column, you can see that there's a positive correlation of 0.79. So that's very, very highly correlated. So anything in blue is basically pointing at a high correlation. Anything in green is low correlation. So it's not saying that there's negative correlation, it's saying that there's a low correlation between the two, which is ideally something that you would want. And actually, we've got no purple examples on here, so there's no negative correlation. When you look at modern portfolio theory, typically people want to see some kind of negative correlation between two asset classes. But right now, if you look at a like previous 10-year period, um, there are no negative correlations and a few low negative correlations. And the standout two of low correlation assets are gilts, total return, and direct property, total return. And so let's look into that a bit more detail. So, yep, gilts historically have had low correlation, but you saw what happened in September there. So that then we moving into very positive correlation, and it's going to be interesting to see how that pans out over the course of the year. So that has been a good diversifier, but will it be a good diversifier going forward? UK direct property, again, low correlation. But again, we've seen that over the course of the previous few months, there's been a spike in volatility, so positive correlation. So again, that's an area where we just need to keep an eye on what's going to happen with real estate, REITs, infrastructure going forward. So I think these are important things for us to understand around what's happening in markets at the moment. If we look at some of the cash flow modeling tools that are available, we've got a number of different types of modeling that we use. So these BRIA scores are telling you which ones are likely to be the best at predicting what's happening going forward. And broadly, the lower the BRIA score, the better it is at predicting what's going to happen. So understanding how cash flow modelers arrive at their outcomes, I think, is really important. So these are the four examples. You've got historical, traditional Monte Carlo, reduced CMA Monte Carlo, and regime-based Monte Carlo. Of those two, historical and regime-based seem to be the best predictors of how things are going to pan out going forward. Now, why is that important? Well, it's because of something that you don't really have to worry about at all in accumulating assets, and something that is a concern in decumulation. So when we're looking at an accumulation portfolio, if you look at these two portfolios, broadly, doesn't really matter which one you're invested in, as an example, they're going to end up at the same point. So in 30 years' time, portfolio A matches portfolio B. They've both got an average of 5% per annum investment return over a 30-year period, and although the journey's been very different, the outcome is basically the same. Now, when you're taking money out of your portfolio, then things will look quite different. So when you're decumulating, the order in which your returns arrive is critical to the outcome. Excuse me. As you can see here, portfolio A, because it had a positive sequence of returns early on, the portfolio hasn't, has been able to last effectively the full 30-year period. Whereas portfolio B, because it had negative returns earlier on, you're drawing income at a point when the portfolio has performed negatively. And so that portfolio has shrunk in value to zero after about 26 and a half years. So the sequence of return is really important when you're decumulating. The other thing that we need to be concerned about right now is capital market assumptions. So this is some data from JP Morgan looking at their, capital market assumptions, historical returns since 2009, and you see there's some sort of real outliers there. So US large cap, but nearly 17%. But if you look at what they're predicting going forward, their views on how different parts of the economy are going to perform are significantly lower. So effectively, we're potentially moving into a period where in the coming 10 to 15 years, return from equities and some of the growth strategies that we've been thinking of will be significantly lower than they have been in the past. And that's an important factor to consider as we move forward. We also mentioned the risk appetite is changing. But the most common objective for retirement planning in this Next Wealth report was to use our savings to create a sustainable retirement income. And that is cited as a main goal by almost 90% of advisors. So this, in this context, is where we're talking around what we can do to fix
JP,
portfolios. Yeah, go for it.
Just a quick question. And again, Paul Claro's put something in the chat. I don't know whether, Paul, you want to unmute and sort of make your point. Do we all agree that what you've just said is true, that, presumably equities are going to be less attractive going forward? And that's effectively what you're saying, isn't it? In the next 15 years? I mean, do we all agree with that? I mean, Paul, do you want to question that, or
yeah, well, nobody, as people keep saying to me, nobody's got a crystal ball. So we just don't know. All we can do is look at history, isn't it? And there's a lot cleverer people than me that look at the data. And there's a team at GMO, Jeremy Grantham, the sort of grandfather of investment management, on what I would call the honest side of the sell side of markets. And they do their number crunching and produce it monthly. Large caps, small caps, bonds, this, that, and the other. They do a nice little chart. Yeah, you can download it. It's not a problem. And their current position is that large caps over the next 7 years will be minus 2%. So, yeah, I mean, it's on the bearish side of things for sure. But I think, we can't have a cake and eat it, can we? We can't say that long-term equity returns are 6-7% a year real, and then they go through a long period because of zero interest rates and QE of doing 12 or 15% a year. We can't just say, well, they'll keep doing 7%, can we? That's ridiculous. So we've got to, take account of valuation.
Yeah.
Which show was that? Sorry, I didn't hear what you said. Oh, sorry, yeah. I thought Superx was very good. Yes. I didn't think it should be good. I thought it was really, really funny.
You got someone who's muting there.
Yeah, I think so. So yeah, I agree with you. I don't think that we can say absolutely that people are going to see 7% returns, 10% returns, significant increase in equity returns going forward. I think one of the things that we can look at is, as you rightly point out, historically, what have equity returns looked like? And broadly, they've been at around cash plus 5. Will that continue as we move into the next 10 to 15 year period? I don't know. I haven't got a crystal ball, but I suspect that we might find that the equity risk premium is reduced for a period of time, and maybe not an insignificant period of time as well. I guess are the two things that we're saying with this slide deck. And this data is not just saying it. We've taken that data from JP Morgan, so we're just using their capital market assumptions and saying that they're a bit like you. There are people who actually do this for a living. They think about what the investment strategies are going to deliver going forwards, and they're quite bearish on what equity returns are likely to look like going forward. Does that answer your question?
Yeah. Paul, Henry. Well, Paul, I don't know if that answers your question, but Henry's now raised a hand. But Paul, are you happy with that?
I think what we're looking for in this meeting is something which isn't about the speculation of where markets are going to go, more to do with solutions to problems which the market has, and particularly the problems with regard to spending our pension pots. So could you focus a little on that?
Yeah, absolutely.
Thank you.
Just get in there.
Yeah, I just appreciate where sort of.
Yeah,
You're stealing JP's thunder now, Henry.
Almost there, Paul. Honestly, this is the slide that does that. I think starts us on the journey. Henry, did you have something you wanted to ask? Sorry.
No,
that was Henry's challenge.
Oh, okay. So here, let's move on. So this is a traditional 60/40 portfolio in drawdown, and what we're going to look at is what can we do to enhance that portfolio, primarily to meet two key objectives. One, to meet the sustainability outcomes from a customer's perspective, and two, to enhance the legacy provision for the customer. So these are the things I want to understand. How do I get a higher income given inflation? How do I improve its sustainability and financial resilience? And how can I improve my legacy benefits? So that's what we're going to get into now. So you remember that slide that I showed you right at the beginning? Here's a less sustainable portfolio, 400,000 at 4%, 50-50 split between bonds and equities, legacy provision of around £127,000. If you build in 20, so if you take the bond allocation, so we've spoken a little bit around how a bond's going to perform going forward, and do we think they're going to be more aligned with equities? Answer is yes. And do we think that the returns are going to be amazing from bonds? Total return might improve over time, but in an interest rate hiking environment, the capital value of the bonds will drop, and we believe we're still in that hiking phase right now. So, capital values of bonds will fall. So if you take some of your bond allocation, so you reduce your bond allocation from 50% to 30% and add 20% into our secured lifetime income solution, which is a individualized proposition available on a platform. So it pays income for life as a cash payment to a platform cash account. So if you put 20% into that, remove 20% from your bond allocation, you get a much better outcome. So your portfolio is now deemed to be on track. So this modeling is done by Timeline. So it's now got 81% chance of sort of being successful. But look what it's done to legacy provision. So that's gone up by 66%. So just by adding secured lifetime income to that solution, you've created better legacy and a better outcome for your customers. And we can take that a step further. So if we take the bond allocation down a little bit further, so we say, okay, we're going to now reduce the bond allocation to 20%. We're going to increase the equity allocation to 55%, and we're going to increase the element that goes into secured lifetime income by a further 5%. What happens now is your portfolio modeling is still on track, slightly better outcome, but your legacy provision has more than doubled. So not only is this good for the customer, because obviously they've got greater legacy provision, they're more likely to find that their portfolio is sustainable. It's also good for the advisor firm, because that kind of result aggregated up across the entirety of their retirement book can have a significant impact in the valuation of their business. So I think that this modeling shows that by taking the kind of good bits of an annuity, plugging it into something that sits within a platform, and allocating to it as if it was an asset class, taking some of the bond allocation out and putting in secured lifetime income, gives you a significant advantage, because here what we're effectively saying is that SLI is not correlated to equities or bonds. It will just pay a secure lifetime income for as long as a person who's taken the product out is alive. And so because it pays every month, the money doesn't increase or decrease. It means that it's not correlated to the other assets within the portfolio. So this, I think, this gives a new and different take on how to use SLI within a drawdown portfolio. So how does it work?
We've got a question from Billy Burrows.
Yeah, go for it, Billy.
Billy, do you want to unmute Billy and ask a question of JP?
Yeah, sorry, do you mind just going back a slide?
Yeah.
Thanks. So I was looking at this and it sort of seems counterintuitive to me, because if you're buying an annuity and substituting bonds for an annuity, where do you get the outperformance from? And when you've got the 30% bonds, what duration are those? Because if they're the same duration as the annuity, then I'd like to know how you get the outperformance, please.
So
where does it come from?
Yeah, so when you purchase anything that looks like an annuity, so secured lifetime income isn't actually an annuity, but for argument's sake, let's say that it is. You get a cross mortality subsidy. So because you pool all the risk, we're able to give a higher income than just a fixed income portfolio would deliver.
Yeah,
so we don't.
Yeah, but the mortality cross subsidy isn't going to account for all of that, is it? Or does it?
Yeah, it'll be quite significantly higher typically than what you'd get from a fixed income portfolio. So it will account for a fair chunk of it. But the other thing is that the rest of the portfolio, because effectively this is an annuity, your income payments aren't at risk. So the rest of your portfolio doesn't need to work as hard to deliver the income, if that makes sense, because a significant chunk of your income is coming from the annuity.
Okay. Maybe you'll take it offline, but I'd be very interested in just looking at those numbers, because intuitively it doesn't chime with sort of my understanding. But anyway, that's great. Thanks.
No problem, Billy. So how does it work? So secured lifetime income is effectively a trustee investment plan that's available on the SIP. The income is paid into the SIP's cash account, which gives the customer some optionality around what they do with the income. So let's say, for example, the customer was to inherit some money and doesn't need an income for a year. The income gets paid into the cash account. The customer doesn't need to take that income. They can leave it in the cash account, or they can reallocate it to the rest of their portfolio. And interestingly, they don't pay tax on the income until they take it out of the SIP. So the income is only taxable once it's come out of the SIP bubble. So prior to that, once all the money going into the cash account just stays in that cash account in the SIP, sort of free of tax as you'd expect. But SLI sits alongside your drawdown portfolio. So if you are taking income, the two elements of your SLI and the income generated or income required from the drawdown portfolio are paid out to the cash account at the same time, and then paid to the customer as an income after that. But I think the key thing for me is that SLI gives you some optionality around what you want to do with that income, which you wouldn't get from an annuity. An annuity would just pay you directly, tax reduced, as you'd expect. So this example here just looks at taking some of that optionality and using it within the portfolio. So what happens if you reinvest the income. So again, this is a 50-50 split. Legacy provision of 400,000 becomes 771,000. With SLI, your legacy provision goes up to 1 million, because obviously you're getting that income reinvested within the portfolio. So the rest of the portfolio doesn't need to work as hard. So here are some of the reasons that you can see that I mentioned, Billy, earlier. So low volatility, less overall correlation, higher legacy, and there's less longevity risk as well, because obviously SLI's got a longevity sort of play alongside it. And that equates to a 39% increase in AUM.
JP,
Okay.
sorry, just to say,
Oh.
we had a hand up from Terry Jordan. Terry, did you want to ask a question, or was that a mistake? If you want to unmute Terry.
It wasn't to ask a question, it was to support JP. So I work for JP at Just, but it was just to try and answer
Oh, do
Billy's
you?
question.
Oh, well, nice of you to decloak.
So I'm just writing a message to Billy to try and answer that question. So he'll be in writing rather than me stealing JP's thunder. So I'll come back off mute and then answer it via the chat.
Yeah, no, that's fine, Terry. Thank you very much. Yeah, that's really good. And following Billy's question, I think what we're all interested in is, where does this come from? This improvement, I think.
Yeah. Okay. So let's look at this enhanced outcome piece then. So if you're here, we're looking at a 60-40 portfolio. Sorry, I thought someone was going to come into the room then. 60-40 portfolio. We've got 400,000 invested, and that sort of coral line that you see decreasing over time, that is your portfolio in drawdown. The orange line shows a 75-25% split between the MPS provide 60-40 basically portfolio and secured lifetime income. So at the point of crossover, there's a 78% probability of survival. And I think that's a really important point, because effectively what we're saying is that customers are quite likely, to make it to that point. Whereas most customers believe that they're not going to live beyond 80. And so if their portfolio sort of runs out at 82, which most drawdown portfolios do, then that's absolutely fine. But actually, the 1 in 2 survival point is age 91. So, you know, you should be managing a portfolio to last much longer than average life expectancy. If you extend that a little bit further, as you get to the 1 in 2, 1 in 4, and 1 in 10 survival points, obviously the gap between the coral line and the orange line grows pretty significantly. And again, that's because you've had more income coming through from the secured lifetime income element of the portfolio. So this part of it, I think, is really important, because effectively you're taking more risk with the I'm running over a little bit. You're taking more risk with the equity portion of your portfolio, and less you don't have to take any risk with the SLI portion of the portfolio. So overall, your portfolio performs much better. I'm going to move to outside, guys. I've got someone coming into this room. Is that okay?
Of course. Yeah, no problem at all. Yeah, we've got 20 minutes, so we're all ears. We're all ears, JP. So
Okay. Actually, I've got this room for another 10 minutes, so it's fine. I'm going to ignore it. Let's keep going. Okay, so that we broadly come to the end of the session now. So I'm kind of happy to go into more detail on any questions that anyone's got.
Okay, Henry, you got your hand raised. Do you want to ask a question?
I understand the principle of what you're trying to do, which is to allow people to take more risk by underpinning a certain amount of income through the purchase of an annuity, and that this is a good way of protecting people against living too long. It's a general principle of annuities is good, all that, but I really can't understand why it has to be done on an advisor's platform and why you need to use a tip. Is that because advisors won't use annuities unless they get the embedded value of an annuity as part of their AUM? I think that's the right term. I mean, is this a sop really to IFAs to get them to use annuities, or is this really valuable to savers? Couldn't we do this better by purchasing the annuity directly from an annuity broker and just establishing it as part of our portfolio with managing the rest?
I guess there's a couple of elements to that. So one, I think the principle of having an annuity as part of your investment portfolio is fine, but you then don't have that optionality around the income taking. So if people's circumstances change and they don't need the income, there's no real way of switching that off with an annuity. You keep getting it. The other element that I would say is that it's not a SOP. I mean, if you're an advisor, if you've got everything on a platform, it just makes your life much easier. So if you're, looking to hold a portfolio and hold an annuity, then it's up to you as an advisor. It's not so much about, are you getting paid for it? It's more about how easy is it to get a valuation, to tell a customer about what they're doing and to understand that process, and having it all available in one space just makes that
okay, but is there a cost?
Simple.
Is there a cost? I'm asking the question here as a punter. Yeah. Am I going to get a lower annuity rates through the tip than I would do by going directly to someone like Retirement Line?
Typically not. So if we were to look at our own rates, so our annuity rates and our rates for SLI, they're broadly similar. If anything, SLI is slightly better because it's actually overall less admin. So I can't talk about what you would get from the market, because obviously the market rate that you get could be better. But if I talk about SLI as a solution, then actually the rate will be there or thereabouts. If anything, it'll be slightly better than what you would get from just directly in the annuity proposition.
Okay.
Is that compared to a standard annuity, JP, or you don't get underwriting on this SLI?
Yeah, you do.
You do.
Yeah.
Right. Okay.
Yeah. So it's individually underwritten. So postcode, health questionnaire, all of that is done. So what we've showed you is worst case scenario: perfectly healthy person in a very good postcode. If we get a worse postcode and less good health, then the thing only gets gets better. The rate only gets better.
Does that include impaired as well, JP? You can do an impaired version of that as well, can you?
Effectively, yes. So yeah.
Wow. Okay.
So Billy's come up with an interesting question. So why don't you overlay mortality cross-subsidy across the portfolio? I know this is something that you've been thinking about in terms of investment annuities, because we had a presentation on this from one of your guys a few months ago. Is that still something that's on the cards?
So you mean, sorry, just to be clear, you mean highlight the fact that we've got a cross mortality subsidy as part of it, and what that cross mortality subsidy is equal to? Is that what you mean? Because the cross mortality subsidy is already sort of part of the solution, if you see what I mean. It's reflected in the rate.
I mean, the concept that was being sold to us previously was that we could invest a portfolio and that you would provide a mortality wrapper around that portfolio, along with lots of other people, so that effectively we had an investment annuity which got the benefits, the long-term benefits of investing in real assets and the longevity insurance, so that we were effectively being underwritten as a pool. Is that concept, is that sort of still on the stocks? Is that likely to come from Just at some stage in the future?
So I think if I've understood the question correctly, SLI does do that. So SLI does offer customers that cross mortality subsidy
But
within
the annuity pool. Yeah.
So it is a pooled solution. Yes.
Yeah, it's a pooled solution.
Yeah.
What Billy, I think, is asking, and I'd be prepared to back him up on this, is can we see another form of investment other than an insured annuity? Yeah.
Right.
So
Got
could
you.
we see
Yeah.
this as a non-insured?
Yeah. So we're looking into that at the moment. That is something that we are sort of actively looking at right now. So our propositions team is interested in looking at how we might be able to introduce that to the market.
Okay.
Yeah.
Okay. JP, we've got another hand raised by Stephen Lowe. Stephen, do you want to unmute and ask a question, or challenge, or
Thanks.
make a point, or poke
Thanks,
JP in the
Stephen.
eye, or
Yeah, I should disclose that I'm part of the same group, so you can probably expect this as a loaded point. I suppose I'd just make an appeal to everyone to don't think about this as an annuity at all, and therefore my question, JP, is it's a guaranteed income producing asset. It's just another asset that sits in a portfolio. So my question is, I've seen that you've been working with discretionary fund managers to embed this new asset into their portfolios. So they don't view it like an annuity, like probably we've got into on this call. They put it in as a new asset to try and blend their portfolios. So how does that work in practice? That's probably quite interesting to this audience, I would think.
Yeah, that's a good point, Steve. Thank you very much. So what we've done with other model portfolio service and DFM providers is in effect what I showed on that one of the earlier slides, where we treat the SLI allocation as part of the bond allocation. So we replace the gilt element of the portfolio with SLI because it's a guaranteed income for life. So basically that guaranteed income can be thought of and is being thought of by some of our DFM partners. So Copia, for example, is live at the moment as an income producing asset available on the drawdown platform. So it is actually taken into consideration as part of the overall drawdown structure. So it does actually deliver a much better outcome for customers because the rest of the portfolio is taking into consideration the SLI part and not needing to generate income that the SLI part is generating, if that makes sense. So it's been well received by the market.
okay. Thank you very much, JP. Billy, you got your hand raised, and then maybe I might come to JQ, who I love very much, because I'm going to ask the questions about what are other insurers doing in this space. But I'll come to JQ in a minute. Billy, go on, you go first. Yeah.
Yeah, just very quickly. I mean, Steve, I totally agree. I mean, I've been arguing for donkey's years that if you're looking at de-risking a drawdown portfolio, think of annuities as replacing some of the bond yields. But I mean, I don't want to hark on, but I still can't get my mind around those numbers of the outperformance, because logically, if you are thinking of another asset class, then SLI will be an investment, in bonds with mortality cross subsidy. And unless there's big differences in, duration, in fact, unless, perhaps instead of going into, bonds, you're going more into, sort of corporates, and sovereign debt. I still struggle where that outperformance comes, but I don't want to, hog the conversation on here, and perhaps that's something we can, take offline. But I think you're right, look at a different asset class.
Yeah,
Okay.
I'm happy to pick that up with you, Billy.
Yeah.
I'll
Cheers,
get in
Billy.
touch with you separately.
We'll get I'll get the details to you, Billy. That's fine. JQ, can I come to you? I mean, obviously, putting your actuaries head on, and many years of insurance company involvement. What are other companies doing? Are there other versions of this coming out or not? And if not, why not?
Not in the retail market. I mean, GICs have been used, guaranteed income contracts have been used in the US for many years, and the pickup here is really, or the general pickup in the GIC model is longer dated, more liquid. There's a downside of solvency capital, which is the the solvency capital in the GIC is the majority of the solvency capital you'd have in an annuity anyway, without longevity element. So there's merit. There's merit in having a GIC in a framework. I think the point about it being cheaper, there's a question mark about. Clearly there's an additional platform cost, because it's not an annuity cost, it's a GIC cost, and it runs through. But no, GICs haven't been popular in the UK well, they just haven't taken off for whatever reason. But I can see them. I mean, I'm looking at them for all sorts, for other reasons, and there is a place for them. I think without being too spiky, I think one of the challenges always when you model is to ensure the efficacy of the underlying modeling. When you take something out and put something else in, that what you're taking away and what you're putting in have got the same underlying implicit capital market assumptions as well. So this is back to Billy's point. If you're taking A out and wrapping it and putting it back in under a GIC, surely the answer should be the same. So it's slightly different portfolios as a consequence, and that's somewhat to do with the mark-to-market unit-linked approach in bond stroke fixed income portfolios. I think that's certainly what I've seen in the institutional space anyway.
Okay.
I don't know if that helped at all.
No, it's good. It's good. Henry, you got your hand raised. You need to unmute, Henry.
Yeah, my question is, presumably this product doesn't have property rights. You can't have your cash back once you bought one of these things. It doesn't revert to you if you decide you don't want to be in it anymore, or is that not the case?
So there are two elements to that. So that part one is it has got a death benefit, which is 75% of the initial value. And it has got a cash-in value as well, which is not quite the same, but similar to the death benefit. It reduces by 2 times the income paid out. So over time, the income that you receive reduces the value of the cash-in, if you see what I mean.
But on that basis, there must be a pricing implication, because those things cost an insurance company to do. I mean, how could you possibly price this as the equivalent annuity rate if you're giving people those benefits in addition to what an annuity gives? I can't assume.
So this is an admin play on the platform. So basically, the cost of setting it up and managing it is significantly lower than it would be for a normal annuity, because actually it's all tech enabled. So the rate in which that we're able to play is designed at outset to be more, there or thereabouts the same as an annuity, taking into consideration the cost of managing it, looking after it, and equally building some elements into it that we know that people don't like about annuities, such as you get no death benefit and there's no cash in value at all.
Okay. Terry, you got your hand raised again. Do you want to just make a point on that particular area? I mean, presumably this is a unitized product then, isn't it, JP? If on a particular day you can give a death benefit, it's a unitized product then. Is it priced every day?
It is priced every day. Yep. Yep.
Wow,
It's got
okay.
So even when eventually that price drops to 0, it still pushes a price into the platform every day.
Wow. Okay. Sorry, Terry. Yeah, go on.
Yeah.
Make your point or ask a question. So.
And the point I was going to make to try and answer Henry's in regards to it can also be transferred to a more standardized annuity as well. So if the client doesn't want to run those assets through the SIP anymore, it can be converted into a lifetime annuity into the client's own name as well. So that's a feature that's already built in that is convertible. Sorry, is the word
Okay.
I was thinking of.
But Terry, that's only with you. That's not an external transfer value.
Do you know what, Steve? I don't know the answer to that. I think the.
I got you. I got one good question.
Yeah.
Hurrah!
Do you know? I'll find that out, Steve, and I'll send that to you. But
okay. Yeah.
Yeah.
Well, you know, in 5 years' time, you know, somebody else comes along with a version of this ×2, and some of the IFA community go, well, that's better than yours, so we'll jump out ship and go to the other one. So possibly, if I was you, I probably wouldn't give an external cash transfer value, but maybe the market would push you to offer it. I mean, death benefits sound good, but yeah, go on.
Yeah, whilst it has a value on the platform, that can basically be cashed in, and that would just be returned back into the client's SIP portfolio. What I'm talking about is if that asset value is then depleted down to zero, i.e. the guaranteed asset running alongside it, it will never stop the income being paid in. But if the client wants the income paid into their bank account rather into the SIP account, that's the bit I'll just need to double check, Steve, is that would we allow that any annuity? But I mean, my instinct is telling me no, it is us. It's just annuity that'll pay that. But I will double check that because it's not something I've been asked before.
Thanks for your
Steve,
comment.
you might know the answer to that.
Yeah, Stephen, do you want to just make a point?
I was going to make a slightly different point, Stephen, just for the members on the call, which is this is an open architecture environment. So what sits at the front of this is a piece of technology run by a company called Spire, and any insurer's equivalent of what JP has explained can be plugged into it. So to your point, Stephen, competitive tension can be created by, you know, Phoenix, Standard Life, Aviva, anyone else plugging something into it. It just so happens that Just are the first ones to plug something into it. So the intention is it will be open architecture and anyone can play.
Okay. Peter Cameron Brown, you've got a question in the chat about impact on DB schemes. It's probably not the same thing, but do you want to ask the question anyway, Peter?
Yes, it's just a random question, really, but listening to the session, coming from a DB pension scheme background, I just wondered if it would be available to a DB pension scheme as an alternative vehicle to a bulk annuity buy-in.
It's a great question. So you mean contacting members directly and giving them access effectively to something like to SLI to offset the scheme's risk? Is that what you're
saying, that's Peter? What I was thinking of. That particularly if there's a sort of cash-in value as well.
I think I think from a member perspective, the scheme would probably have to do something quite exciting to get people to want to move into the DC space in the first place. But it's got potential to be used to de-risk in that way, I think. Yeah, I hadn't actually thought about it, to be honest, but it's a great question. Possibly,
so instead of getting one retail client, you get 50 buy-ins or buyouts.
That's right. Yes, I mean the scheme can buy in without members' consent. So
I think it would be difficult because of the scheme.
Yeah, but it'd be difficult because
it's individualised and personalised.
Yeah, but you'd have the individual's details, so it's got.
Yes.
It's a really good question. It's something we need to think about, but it's a possibility. Need to think about it.
Yeah.
But thank you.
That could be a bit of a game changer as well if you could do that as well, JP. I mean, you see what you can achieve in an hour on Patron Playpen on a Tuesday.
Absolutely.
See what you can achieve. You know, take on the world. So there you go.
Absolutely.
So that's good. Let's just double check the chat just to make sure there aren't any other questions outstanding. I think. Yeah, thanks, Billy, for your question. Thanks, Peter, for yours, and Stephen for responding. James Franklin Adams. I'm not sure if James is still on, but I think you are, James. Do you want to unmute to make your point regarding outperformance?
Yeah, no, it's just a theory as to why why they might get that outperformance is that the durations being different, like Billy pointed out, that if you're selling the bonds, which are going to give you a lifetime income for a long time, and buying this an annuity or this product, then which might have a shorter duration, you might get the money that way, the outperformance that way. I wasn't sure. So questions,
Okay.
JP and crew.
Yeah.
JP, do you want me to pick that up? Just to answer.
So
I've tried to answer in the chat.
yeah, so let me have an initial go. So I think Terry, feel free to sort of jump in. So my sense with this is that there are a number of things that are happening to generate the kind of the rate. One is, you know, how we manage the assets that we run, and then secondly is the additional secret sauce, if you like, of the cross mortality subsidy. So that cross mortality subsidy is the bit that typically you don't get access to from bonds. So if someone asks me, you know, why do rates on things like annuities and SLI and etc., why are they higher than you can get from the underlying asset? The main reason is that if you're kind of building a portfolio for yourself to last for as long as you live, you've got to take less overall longevity risk. So you want your portfolio to last for as long as possible. As an insurer, because we're pooling that risk, we only need to manage to average life expectancy. So that tends to make a pretty significant difference in terms of the rate that we offer, and that aggregated up over time can be pretty significant. Alongside that, the other part of your portfolio, no longer do you need to let's say with £100,000 you can buy 7%, so £7,000 worth of income. You no longer need to provide £7,000 of income from your drawdown portfolio because SLI is doing that. You can afford to take less income from the rest of your portfolio, and so that tends to make a difference in the modelling as well. Does that make sense, or still not?
Yeah,
there?
that makes sense, particularly the first part.
Yeah. Okay.
Thanks.
Thanks for your question. Thanks for your question, James. That's good. That's good. JP, we're sort of slightly over now, but
Yeah.
I think from what you've heard today and what we've seen, it looks a very interesting development in the decumulation space. And you know, so number one, good luck with it. I hope it goes really, really well. You'll be obviously selling
Thanks,
millions
Steve.
and millions and millions of pounds of it.
Well, definitely
and-
now that you guys are all
Oh, of course,
excited
yeah,
about
because of us, you're yeah, exactly. But if anybody wants to talk to JP offline or Stephen Lowe offline or Terry offline, then come to myself or Henry Tapper. We'll obviously pass the details on. JP, if you could send us the slideshow as well, that would be good.
Yeah.
And also in the chat, Stephen's posted some links to some example portfolios in there. So thanks for that, Stephen, as well. That's really good. And JP, thank you for your input, your time, and your presentation. Maybe you've converted some people this morning, I think, and you're moving in the right direction. So thank you very much, Steve, for your presentation.
Thanks, Steve.
If you could stay on, JP, as well, that would be good.
Yep.
Next week, we have got Tumalo,
Cool.
which a lot of people will know. But we'd like to know more about Tumalo and what they're doing in the governance space and the voting space. So I think Tumalo could be a really good presentation next week. You know, thank you. If you're on Playpen, thank you very much. If you could encourage others to join Playpen, we'd really appreciate that. If you're not on Playpen, please join, and I hope you enjoy these sessions. So as usual, we want to pray for peace in the East yet again. And this video and this session will be posted online this afternoon on our media tab. So thanks everybody for your support and for your input and for your questions, and enjoy the rest of your day. And it's a really, really good session. And I'm sure you'll join me thanking JP and team for that great insight into your new product. So thank you very much, JP. That's really good.
Thank you.
Lots of clapping and thumbs up. Cheers, James.
Thanks, guys.
Thanks, JQ. Really appreciate that.
And
we'll
Billy,
see
we
you
should
next week.
pick up.
Yeah, well, I'll put you in touch with Billy. Yeah,
Yeah, that'd be great,
Billy.
because he had some really good questions. I think it's really useful.
Yeah, no, Billy's he's got a lot of experience in the annuity space, especially, and it was very useful session. So yeah, really good. Henry, you are clearer now as to what this product is and the platform and why they're doing it. Are you clearer, Henry, or maybe Henry's frozen?
It's frozen.
Maybe Henry's
Yeah,
gone.
looks like it.
Oh, there you go. A quiet, peaceful Henry. There you go. So that's good. So there you go. Right, let's go to people. Thank Chris Giles. I think Henry's frozen and gone. I think.
Yeah, I think he has. Yeah.
I think Peter's maybe frozen and gone. So yeah, there we go. So JP, just wanted to say thank you much indeed for that. At the very end of this session, we usually just say, number one, in 1 minute, tell us what the session was all about. And then I'll ask you probably about what you thought about the content and the questions, the Q&A session, probably what was your most challenging question, I guess. But yeah, as a short summary, what was today all about? And don't be afraid to promote Just.
Yeah, so I think it was just about getting the SLI story out there, thinking about it from an asset class perspective rather than an annuity point of view. But I love the way that people just jump to annuity. So that's fine, because people just need to wrap their heads around it. And if you've got a mental shortcut that says this is this, then that works for me. But no, I thought it was really good questions. Yeah, enjoyed it actually. Hope it came across well.
Okay, it came across very well. I mean, and so what is the essence of SLI? What is SLI in 10 seconds? What is it?
So SLI is a way of introducing a secure income into a drawdown portfolio on a platform, and you can use it, potentially as you might think about using annuity, but equally you can use it in a way that is more aligned to the way that investment managers think about risk. And so, because if you think about it in the way that investment manager thinks about risk, you can start to think about how correlated is it to other asset classes, and what am I getting from it.
Yeah.
And I think that those two things came out really well.
Yeah, and if any consumers or IFAs are watching this, one of the big pluses is about the death benefits. If you want to just summarize the death benefits, that'd be fantastic.
Yeah, so when we built this, I guess the two key things that advisors didn't like about annuities felt a bit all or nothing. So one of the things with annuities is you just literally take your whole pot, buy an annuity and forget about it. This is a more evolved element, and one of the things we wanted to take into consideration was what happens if you die too early, for want of a better word. And so we wanted to introduce a death benefit as part of the solution. So 3/4 of the value of whatever you put in. So if you buy 100K's worth of SLI, 75K would be paid out as a death benefit if you were to die the day after you invested. That benefit reduces by 2 times the income paid out.
Wow.
So it drops.
That is a marked improvement to a traditional, let's call them Victorian annuities.
Victorian annuity, exactly.
So there you go. No, that's really good. JP, fantastic session. Thank you very much. If you could send us a slideshow, that'd be great.
Yeah, I'll do that.
Enjoy the rest of your day, and please, join Playpen or join other sessions.
Absolutely.
We've got Tomolo next week. I'm trying to get Steve Webb for the following week. So
okay.
We'll try and get some people on there. So really appreciate your input today, and really good session.
Yeah, and the best question for me was that one from Pete about the DB, most challenging, because I hadn't actually considered it at all.
Well, when you think about it, it's all about data, isn't it? And at the end of the day, if you get 50 questionnaires, surely it's better to do 50 cases than one case. So you get 50 questionnaires, 50 rates, 50 policies, and away you go.
Yeah, just something that didn't occur to me. We've got a DB de-risking team, and I might talk to them about it and just see what they say.
Yeah. Well, you could you could promote it through Playpen, couldn't you? You see?
Yeah, absolutely.
Yeah. Or you could give
Absolutely.
Playpen the rates, and we could become a hub for We Are Just.
Yeah,
Or Just Read.
absolutely.
And I
Sounds
can't say
great.
hub because that's part of you as well, isn't it? Hub.
Yeah.
No,
It's okay. We'll
I
let you go.
spoke.
We'll,
Yeah,
we'll,
whatever.
we'll,
Yeah,
we'll let you get away with that one.
that's fine. All right, brilliant.
All right,
Okay,
Steve,
JP. Thanks very much
lovely to
indeed.
spend time with you.
All
We'll
right.
speak
See you
soon.
later.
Cheers.
Cheers.
Bye.
Bye. Bye.